Welcome back to The Explainer. Today, we're jumping right into a foundational pillar of the U.S. tax system for accountants. Section 4, How Business Entities Are Taxed. Honestly, if you want to master tax and, keep your clients from paying thousands more than they actually need to, you absolutely have to master this. In our previous lesson, we unpacked the whole IRS authority hierarchy, going all the way from the U.S. Constitution right down to IRS publications, so we know the rules now. But before we can even begin to apply a single tax law, we have to stop and ask, who is the taxpayer? Determining entity classification is your prime directive. It's basically step 0 before any true tax analysis can begin. Because here's the reality. Entity choice literally changes everything. It dictates the tax rate, exactly who cuts the check, and the timing of the payment. Imagine a client walking into your office with $1 million in net income. If you apply the wrong business model at the very start of your analysis, you're guaranteed to produce the wrong tax liability. Confirming whether an entity is a C Corp, an S Corp, a partnership, or a disregarded entity is the absolute first question you've got to resolve. Let's do a quick flyover of the landscape here, starting with sole proprietorships and default single-member LLCs. The IRS considers these disregarded, meaning the business income just flows directly onto the owner's individual Form 1040, specifically on Schedule C, and it's subject to self-employment tax. Pretty simple, right? But if you add another owner to that LLC, it automatically defaults to a partnership. Both multi-member LLCs and general partnerships are what we call pass-through entities. The entity itself doesn't pay any federal income tax. Instead, they file an informational Form 1065, and the partners pay tax on their specific allocable share of the income. Then we've got S corporations, which also act as pass-throughs, but they file Form 1120S. C corporations, on the flip side, stand completely alone. They're separate tax-paying entities filing Form 1120. And finally, nonprofits. They are tax-exempt under sections like 501c3 and file an informational Form 990. But you've got to keep a sharp eye out here. If a charity runs, say, a commercial coffee shop on the side, they get hit with UBIT. That's unrelated business income tax. Section 4.1, the C Corp crossroads, pass-through versus double taxation. This right here is the biggest dilemma you're going to face in tax planning. When you choose a C corporation, you are actively choosing double taxation. And it works in a strict 3-step sequence. Step 1, the corporation makes a profit, let's say $100, and pays federal income tax at the entity level. Step 2, the corporation decides to distribute the remaining after-tax profit to its owners as dividends. Step 3, those shareholders pay individual tax on those dividends, usually at a qualified rate of 15 to 20%. You are watching the exact same dollar get taxed twice before the owner can even spend it. Now, since that same dollar gets taxed twice, you might be wondering, why on earth would anyone ever choose a C Corp? Well, the appeal lies entirely in the corporate rate itself, a flat 21%. But compare that 21% to this number, 37%. That's the top individual tax rate. So the crucial point is this. If your business is structured as a pass-through, like a partnership or an S Corp, all that income flows right onto your personal return. If the business is highly profitable, you could be paying up to 37% on that money right now, even if you just leave the cash sitting in the business's bank account. And this brings us to the core strategic choice. Are you building the next Amazon, planning to retain and reinvest literally every dime to grow the company? A C Corp is hugely advantageous there because those retained earnings accumulate at that lower 21% rate. But if you're running a consulting firm and you expect to distribute most of the profits to the owners to actually live on, a pass-through is almost always better. You bypass the second layer of tax entirely, the owners get the cash, and they only pay the tax once. Moving on to the S Corp trap and navigating the landmines. A lot of people see the S corporation as this perfect, best of both worlds solution to avoid double taxation, but it comes with a major catch. To get that highly desired pass-through treatment, you have to meet incredibly strict eligibility requirements. First, shareholders must be U.S. citizens or residents. Absolutely no foreign investors allowed. Second, you are hard capped at a maximum of 100 shareholders. And third, you can only ever have one single class of stock, meaning no preferred shares with special payout rules. And let me really emphasize the stakes here. Let's say an S Corp owner passes away and their shares pass to a non-qualifying trust. Or, you accidentally sell one single share to your Canadian cousin. The IRS doesn't just give you a slap on the wrist. No way. They immediately terminate your S Corp status and automatically convert the entity into a C corporation.
This instantly subjects the business to double taxation, triggering massive, completely unexpected tax bills that can literally devastate a company overnight.
Let's wrap up this section with passing the baton, getting that income over to the individual. So we've talked about how pass-through entities don't pay tax themselves, but how does the income physically move from the business to the human? It happens through the Schedule K-1. This is literally the baton in a relay race. Issued by partnerships and S-corps, this form is handed to every single owner at the end of the year. It reports their specific, allocable share of the income, the deductions, and the credits. The entity does all the math, puts it on the K-1, and just hands it off. The owners then take those exact amounts and drop them directly onto their personal tax returns. Which leaves us right here, with a bit of a cliffhanger. The business has successfully passed the baton, the individual taxpayer is now holding this K-1 with all this income on it. But how exactly do we calculate the tax they actually owe? What filing status do they use, and how do we build out their personal tax brackets? Well, that is exactly what we're going to unpack in our next lesson on individual taxation. Until then, think about this. If a client came to you tomorrow with $1 million business idea, would you put them in a C Corp and face double taxation, or an S Corp and risk walking that landmine field?